Welcome, everyone. So let's dive into one of the most powerful and honestly one of the most misunderstood concepts in the entire world of business, and that is depreciation. Now, I can almost hear some of you thinking, oh, depreciation, that sounds like a really dry technical accounting term. And hey, you're not wrong, it is an accounting term. But I promise you, by the end of this discussion, you're going to see it as a critical, strategic tool for any manager. This isn't just about plugging a number into a spreadsheet. It's about understanding the true cost of doing business, making really smart investment decisions, and ultimately telling the real story of a company's financial health. All right, let's make this real. I want you to put yourselves in the driver's seat for a minute. Picture this. You are the proud owner-manager of a brand new cafe. Let's call it the Daily Grind. You've just written a check for a beautiful, top-of-the-line, $15,000 espresso machine. Now, this thing isn't just a piece of equipment. It's the heart and soul of your business. It's the engine. But here's the question I have for all of you, as future managers, as future business owners. What is that machine really worth? I don't mean today. I mean a year from now or 5 years from now. How do we possibly account for the fact that this incredibly valuable asset is slowly, day by day, cup by cup, losing its value? And look, this isn't just some textbook problem. The answer to this question is going to directly impact the taxes you pay, the profits you report on your income statement, and your ability to plan for future growth. It's absolutely fundamental. So how do we find the answer? Well, we don't look into a crystal ball. Thankfully, accounting gives us a very structured, very logical process to follow. We call it depreciation. And the entire thing, all of it, boils down to 3 key inputs. Now, I really want you to focus on a word I'm about to use: estimates. This is a huge shift in thinking for a lot of you. Up to now, most of what you've learned in accounting has been about recording things that have already happened, right? Transactions with precise dates, precise dollar amounts. You've been a historian. But with depreciation, we are stepping into the role of a forecaster. We are using our professional judgment to make informed predictions about the future. These 3 estimates are the bedrock of the entire process we're about to build. So, where do we begin? Let's start with what seems like the easiest piece of the puzzle, the asset's cost. And you might be thinking, well, that's simple. It's just the price tag, right? But in the world of accounting, the true cost of an asset is often much, much more than what you see on the invoice. There's a vital principle we need to get our heads around first. The foundational rule here is what we call the historical cost principle. The textbook definition says we record an asset at its cost, which includes all expenditures necessary to bring the asset into operation. Now, the most important words on this slide are, without a doubt, all expenditures necessary. This is one of the first places I see students trip up time and time again. They look at the purchase price and they just stop there. But that's not the whole story. The real question a good accountant or a smart manager asks is this: what did it truly cost me in total to get this machine ready to generate a single dollar of revenue? Think about every penny you have to spend to get that machine from the factory floor to pulling that first perfect shot of espresso. And this slide lays it out perfectly for our cafe. The sticker price was 15 grand. But could you make a latte with it at that point? No way. You had to pay sales tax. That's necessary. You had to pay to ship that heavy thing to your cafe. Absolutely necessary. You had to hire a specialist to come in, install the plumbing, hook up the electrical, and calibrate it to make sure it worked perfectly. Each of those costs was unavoidable and necessary to make that machine operational. So in accounting, we don't just expense those costs right away. Instead, we do something called capitalizing them. It means we bundle them all together with the purchase price, and we record the entire $17,500 as the value of the asset on our balance sheet. This number, $17,500, that is our true starting block for the entire depreciation process. Excellent. So we've locked in our starting value. That's step 1. Now for the second estimate, we have to put on our forecaster hats again. We need to answer the question, how long are we actually going to use this thing? We need to determine the asset's lifespan. The official term for this is useful life, and I absolutely cannot stress this enough. This is an economic concept, not a physical one. We are not concerned with how long the machine could possibly last before it just falls apart. The engineer who designed it might say, oh, this thing could run for 20 years if you take care of it. But that's not our question. As business managers, our question is, for how long will this asset be a productive, value-creating part of our business strategy? It's all about its useful economic contribution to us, not its physical endurance. And this distinction between useful life and physical life is where clear business thinking is so important. As you can see here, the physical life might be 15 years, but maybe your strategy at the Daily Grind is to always have the latest, greatest technology to attract those high-end coffee connoisseurs. So your business plan might involve replacing the machine every 7 years, no matter if it's still working or not. Or maybe you do an analysis and find that after year 7, the maintenance costs start to skyrocket and it just becomes uneconomical to keep repairing it. In either one of those cases, for your business, the useful life is 7 years. It's a strategic decision made by management, not an engineering fact. So how do you, as the manager, actually come up with that 7-year number? Well, you don't just pull it out of thin air. You do your homework. You become a detective. You'd read the manufacturer's documentation. You'd get on the phone with other cafe owners and ask them how long their machines have lasted. You'd look at your own business plan. Are you a high-volume shop that's going to run this thing 18 hours a day? Or a small boutique cafe? Do you have a strict daily cleaning and maintenance schedule in place? And like we just said, what's your technology strategy? It's a synthesis of all of this information, both external data and your internal strategy, that leads you to a defensible, professional estimate of a 7-year useful life. Okay, so we have our cost, that's our starting point. We have our useful life, that's our timeline. Now, for the final piece of this puzzle, we have to peer 7 years into the future and make one more really tricky estimate. When we're all done with this machine, what do we think we can get for it? This is called the residual value. Sometimes you'll also hear it called salvage value. It's our best guess at what the asset will be worth on the open market at the very end of its useful life. And let's be honest, of our 3 estimates, this is probably the most speculative one. We're trying to predict the market for a very specific piece of used equipment 7 years from now. It is purely a forecast. So how do we make this forecast as educated as possible? Well, we'd go online, we'd look at used equipment websites and see what a similar machine from 7 years ago is selling for today. That gives us a reasonable starting point. We'd ask ourselves if the technology is likely to be completely obsolete by then. We also have to be realistic. Are we going to have to pay somebody to install it and haul it away? That disposal cost eats into our value. So after doing all that research, the management team at the Daily Grind decides they can probably sell it to a smaller startup cafe or maybe sell it for parts. And they estimate they'll be able to net about $1,400 from that sale. All right, let's just pause here and take a step back. We've done the heavy lifting. We have our 3 critical estimates: a capitalized cost of $17,500, a useful life of 7 years, and a residual value of $1,400. Now we get to the most important question of all. So what? Why on earth did we go through all of this effort? Let's connect the dots and see exactly why these numbers are so incredibly powerful. These 3 estimates allow us to calculate the single most important number for our entire depreciation calculation, the depreciable base. The easiest way to think about this is that this is the total amount of the asset's value that we are going to use up or consume over its lifetime. The logic is actually really simple. We start with what it cost us in total, and we subtract what we expect to get back at the very end. The difference is the total value that will be consumed by the business. So let's plug in our numbers. We take that full capitalized cost of $17,500, we subtract the $1,400 we expect to get back in the end, and that leaves us with a depreciable base of $16,100. I want everyone to really focus on this number. This, right here, is the total cost of using that machine. This is the amount of expense that our business has to account for over the next 7 years. And here it is. This is the heart of it all. We do not take that $16,100 as an expense all at once in the first year. If we did, that would violate one of the most important rules in all of accounting, the matching principle. This principle states that we must match our expenses to the revenues they help us generate. Since our espresso machine is going to be generating revenue for 7 years, we have to spread the cost of that machine over those same 7 years. Each year, a piece of that $16,100 is going to show up on our income statement as depreciation expense. Now, why does that matter? Well, that expense lowers our reported profit, which in turn means we pay less in income tax. It also impacts how a bank would look at us if we wanted a loan, or how an investor would judge our profitability. Think about it. If we get these initial estimates wrong, if we say the useful life is 3 years instead of 7, we could drastically change our financial results, making the company look way more or way less profitable than it truly is for years to come. So, as we wrap up our discussion for today, I want to challenge you to think about depreciation differently. Please, don't see it as just some mechanical calculation you have to memorize for an exam. See it for what it truly is. It's a blend of business strategy, it's forecasting, and ultimately, it's a test of a manager's professional integrity and judgment. I want you to remember this quote as you continue your studies. Accounting is not just about recording the past, but also about making disciplined forecasts of the future. The 3 estimates we've just walked through are the perfect example of this in action. As a manager, you are going to be responsible for making or approving these kinds of estimates. Understanding how they're built and the immense power they have to shape a company's financial story is absolutely non-negotiable. The real skill isn't just doing the math, it's exercising sound ethical judgment. So I'll leave you with a question to think about. Since these are estimates, how could a manager potentially manipulate them to make the company look better in the short term? And what are the ethical implications of doing that? We'll explore that more as we move forward.